it's Jane Biscan from the StartupAngel.com. I have today with me Paul Bricault from Amplify, the new accelerator program in LA. Hi, Paul. How are you?
I'm good, thank you.
Thank you so much for doing the interview with us. So, what is the Amplify accelerator?
So Amplify is a startup similar or in kind to Techstars, which now has multiple units across the country. Started off in Boulder. We modeled ourselves probably most closely to them, although there are a lot of accelerators in the country, like Y Combinator and Techstars being probably the most famous. And we chose Techstars because Techstars operates out of a physical facility, and we felt that LA in particular needs a physical location because it's such a diverse landscape where entrepreneurs basically don't have a place where they can all gather and share thoughts and compare notes and look at each other's wireframes. And we felt that, and we felt that LA really needed something like that. Y Combinator can exist and succeed in the Valley without a physical location where everybody gathers in one place and goes through a consistent program. But we felt like LA, kind of like Boulder, in the case of Techstars, really needed a single location. So that's Amplify. It's a 4-month program. Companies apply. We don't do set start dates, i.e. everyone doesn't start on the same date, so it's staggered acceptance.
So it's a rolling in. It's a
rolling entrance. We accept applications through referral as well as through our website, and then we go through a filtering process where we bring in some of those companies for an interview. Some of the companies that come in for an interview, we go through a diligence process similar to any other venture firm effectively, because we're giving them a certain amount of capital, and companies get from $40,000 to $50,000 in capital based on the number of founders. And then those companies come into the program, they get access to free facilities, free hosting, a suite of various arrangements that we have with local vendors who are providing either free or discounted services. And those range from Fenwick and West, Silicon Valley Bank, PricewaterhouseCoopers,
nice,
Microsoft, TriNet, Frost & Sullivan, Joyent, and
so you just listed a range of really fundamental support structure that a startup would need: HR services like payroll, legal.
Exactly.
You're talking about cloud support, that type of thing.
Yes,
that's very good. And you mentioned $40,000 to $50,000 funding. Depends on the number. And any particular stage of the startup?
Well, because we're an accelerator, they're generally, someone that's raised venture capital probably wouldn't be coming to an accelerator, right? So by its very nature, an accelerator tends to work with early stage companies. Now, the stage of that early stage can be broad. Some companies have come into our program with a little bit of angel funding already in. Some companies have raised not a dollar. And some companies have fully developed platforms with customer traction and revenue. We've had one company that's come in that was already profitable. And some companies come in at an earlier stage without the actual platform fully launched. What's happened recently in sort of the tech startup world is that because of the lowering costs on basically from as a byproduct of web-based services and the cloud and SaaS software systems, and basically the lower cost to basically bring a startup to fruition, we have in not just our community but all over the country companies that could basically launch and build and have a platform up and running, and not just have it in beta, but actually have customers using the platform, whether it's consumer facing or enterprise facing, and actually be generating revenue off of the platform with a very, very small amount of capital, right? And 5 years ago, you would need a few $1 million to get to that stage. Today, depending on the type of company, it could be, you could bootstrap it with a very small amount of capital.
Yeah, it's a very good time to build a startup.
Yeah. So as a result, some of the companies I mentioned that before coming to Amplify, I launched a venture capital fund called the Mailroom Fund in partnership with Excel and William Morris, AT&T, and Venrock, and that was in 2008. And some of the companies we saw there in 2008, in my opinion, were less advanced than the companies I'm seeing today, and those were companies that were looking to raise their Series A of $1 million to $2 million.
Right.
But today, companies, because of their ability to sort of get out in the marketplace and build traction really quickly, we are the beneficiaries of that, I think, because we're able to basically see companies with a far more developed product. So we're not just looking at a PowerPoint and trying to make a bet.
Yeah, just not just a concept. Yeah.
Yeah.
Is there any particular type of company? Or?
We focus on 5 particular areas, but we don't focus on those with strict exclusivity. So, and we picked those areas, which I'll describe in a second, because they've had a history of being successful in LA. So they have an endemic pool of talent to draw from, because we didn't want to focus on businesses in, say, the hard tech or biotech areas where there wasn't an opportunity to draw from a talent pool. We also wanted to pick sectors and types of business that could actually have a visibility towards milestones being reached over a short tenure, i.e. 4 months. And so if you're developing, say, a clean tech company, which LA does have a strong history in, it'd be very difficult to do that inside of an accelerator, because you generally need a lot more time frame and more capital. And so the areas that we're focusing on are gaming, social gaming, mobile, across all different platforms, mobile, sort of a broad context across mobile, social commerce, because social commerce has a strong history of success in LA, more recently with things like Shoe Dazzle and Beachmint. Disruptive media, and by that I mean any company that's disrupting the traditional distribution, production, exhibition path of content. So this could be companies that are directly or tangentially involved in the content landscape or the content ecosystem. They don't have to be producing content, but in some ways, so Spotify would be a disruptive media company. Huffington Post would be a disruptive media company because it's a new what you're doing is a disruptive media company at Startup Angel, because it's a new way of communicating with an audience, right? Instead of the traditional print media version. So anything in and around that area is something that we're also looking at. And then the 5th area is ad tech. And again, ad tech has had a strong history in LA with companies like Traffic Marketplace and Adconian and Overture, and more recently with Burstly, which is a mobile ad tech platform.